Well, thank you very much, Matt, for the lovely introduction. Michael and the team for inviting me back for year number 2. It's always it's a positive sign when you get a second shot at it. Or he's looking for a significant improvement. I can't quite figure that out. Who was here last year? Oh, sorry, in Michael's offices last year. I recognise some faces. Very good. Welcome back, and thank you for attending once again. So I'll just very quickly introduce myself in terms of what I do with Morningstar. Matt and Michael have positioned it pretty well in terms of me working with the likes of Michael, some of our highest value advisors, and naturally with his clients at the end of the day. What Michael and myself and the business that I work for, we're here for you. You're also our clients by extension through Michael, and as you'll see in a couple of slides' time, that is the core focus of our business, is helping clients, end clients, reach your financial goals. Quick disclaimer, any opinion, everything that's on screen is legitimate. Any off-the-cuff opinionated remark from me is my opinion only, and Morningstar will not be held accountable for anything I have to say. There's a warning there. This is being recorded as well, so I do obviously have to be a little bit careful. But I'll also to mention that I will be putting up some numbers, and these are portfolio return or expected return numbers that we use to build portfolios. Those are the sorts of numbers that you would typically use to go and build and construct your own portfolio. Please don't go away. Leave Michael as a client, of course, and build your own portfolios off the back of these numbers. There's a lot more that goes into it than what you see here today. But I wanted to really lift the lid for you so you get a really good understanding of the work that goes into managing the portfolios that you see. Okay, I'm going to break this up into two basic halves. The first half, we'll look at what's happened today. We'll go through some of the noise that we've experienced of late, especially in the last year, and in particular the last few months. We'll look at the performance of a few different asset classes, and I'll call out some important ones that I'd like you to remember and consider when you're considering and looking at your own portfolios going forward. And in the second half, we're going to start to look forward. So we'll look back, consider what's happened or is happening, and think about where should we be looking, where should we be positioning ourselves to make sure that we're protecting the capital or the money that we've invested, but also as best as possible growing those investments. Okay, let's get into it. Please, so through the presentation, I implore you to ask questions. If there's anything that's confusing, raise your hand, yell it out. We have a tendency to be very verbose and use acronyms and complex language. If you find that I'm doing that, please let me know, or Michael will certainly let me know. I know that for sure.
$5 each time you do it.
It's going to be an expensive day, that's for sure. Twice as much as my meal. So please call me up, and I do not mind being interrupted through the presentation. This is a presentation for you as clients. So this is, as a business, this is Morningstar's investment principles, and you see them. You won't be able to read a lot of the text on the screen here. The most important one is we put our investors first. We don't build a business for Michael. We don't do it for his benefit. We do it for your benefit. And everything that we do is geared around building portfolios for you, our clients. It's everything from the way that we think about investing, reducing or eliminating conflicts of interest, which is prevalent in our industry, rife, I would suggest, to striving to minimise costs, the end costs that you see. We're constantly driving down these costs as much as possible because we know the lower the cost for the management of that portfolio ends up in your pockets. So the more that we can do that, the better off you are, and by extension, in reverse, the better off we are as we grow as well. You're going to see me talk about a couple of different concepts today. Value being one, price and value, the difference between the two. And there is a big difference between the price that you pay and the value that you get. You'll see that's a core tenet of what we look at and what we do as a business. And we're going to sort of deep dive and take what they call a fundamental approach. So understand what you own and why you own it. Understanding the profits and the cash flows that you can generate of different assets. So if anything's confusing, it's uncertain for you, raise your hand and let me know. Okay, before we get into performance, how does everyone feel at the moment about what they're reading in the newspapers and what Michael might be saying? How has the economy performed, both here in Australia and globally? Anyone like to call out a couple of thoughts?
It's not moving, nothing's moving. It's
No.
stagnated.
Yeah, flat? Yes? Australia in particular, or everywhere, generally? Everywhere? Okay, yes. Anyone else?
Believe what Michael says.
Outsource everything to Michael. That's a good decision. Well, it's funny, when I look back when we were together in October last year, compared to now, which is effectively a year, there's been so much noise. And a number of events, you saw Brexit earlier in the year. We've obviously more recently seen Donald Trump get up in the US presidential election, and there's been a lot of noise in between. What's really surprising, given that it's been so negative, are how asset classes across the board have been very positive in terms of return. Now you can't see this. The blue bars represent the last 12 months of return, and the yellow, the last 3 months. So if you look at the blue bars, every single major asset class has been positive, which I still find quite surprising when you think about what we've experienced today. Of those, the highest performing asset is Australian commercial property. Roughly 20% return in the last year to September. 20%. International property, the same commercial property, but rather than being based here in Australia, based globally, Hong Kong, the United States, Europe, much the same, 14%.
Could you define what a commercial property is?
Yeah, sure. Who heads down to Brisbane, Sydney, Melbourne at least once a year? Almost everyone. All of those buildings that you see in that city, you'd classify as commercial property, as a group of assets. And as a group of assets, you can pull all of these assets together, and we call them AREITs, Australian Real Estate Investment Trusts. So it's a trust full of property, essentially, and we can invest in those on the ASX. And so that asset class has done roughly 21%. And it's actually done that for the last 4 years. So it's up well over 100% in the last 4 years. It's been a phenomenal growth rate. Infrastructure, like the airport just down the road, that would be regarded as an infrastructure asset. The poles and wires running down the streets, that's an infrastructure asset. The gas pipelines that are running in the outback of Australia, that's an infrastructure asset. That has also done 14%. Now these are really, really big returns. Phenomenal returns, and it's very easy to get caught up in the noise of wanting to invest in these when you see big numbers like that. On the flip side, you've seen cash. Does anyone know what sort of return we're getting in your bank account these days? Not much. Not much. Yeah. What's even scarier is the inflation eroding the value of that cash. And we've seen inflation running at about 1%. So you're getting, I'd argue, less than 1% on the cash that sits in your bank account, that sits idle there. And the reason being, or the reason why these assets, your Australian property, which spits off a lot of cash, so earnings or dividend yield. International property is the same. Infrastructure, it generates a lot of cash flow that gets distributed to investors. The reason why they've done so well is because of the awful returns that we're getting in a bank account. We're seeking alternatives to cash, and they call it the chase for yield. So people have been moving their cash out of their bank accounts into these assets, like AREITs, commercial property or infrastructure, or high yielding dividend stocks on the Australian Stock Exchange, and it's causing them to get very, very expensive. And it's a trend that we've seen for the last sort of 3 years in particular as term deposit rates have fallen. So just keep that in mind as we progress through the presentation. Very quickly, I just want to touch on a couple of different regions around the world. All equity markets, so the share markets, just like our own here at the within the ASX, have also done very well. We've got the UK, surprisingly, given Brexit, doing close to 19% for the year. Surprising, you'd think it'd be a lot lower. North America, so the US, close to 15%. Emerging markets, the likes of Korea, Taiwan, Indonesia, South Africa, 13%. Europe, 2.3%. And Japan, negative roughly 5%. So on the whole, it's been very positive. It's also been very positive in the last 3 months as well. So you've got this picture of glamour and wealth and riches in the last 3 months to 12, which is surprising given the commentary. Likewise, if you look at it from what we call a hedged basis, so if you were to invest in Google in the United States and track the returns if it went up 10%, and we wanted to bring that money back, sell it and bring it back, we'd have to convert it back into Australian dollars. Does that make sense to everyone? Yeah? Yes?
Where do you get all this information from?
Well, as Matt pointed out, we track more investments than anyone around the world. So we have a huge database.
So have you made up that graph?
Yes.
So that's
Well, my investment team has made that up, not me. Yeah. No, I don't trust myself. Absolutely. No. I absolutely. I go and ask the experts to pull all the information out of our system. They'll double check it.
All these figures would be signed off and audited?
Yes, so that's the question I'm asking.
Yeah, absolutely. So it doesn't, I don't pull it out of my personal spreadsheet. No, it comes out of a big database, which is actually hosted in Chicago. Comes down to here into Australia, and the investment team pulls it together. Then it goes through a sign-off process through compliance. I won't go there into compliance teams. Yes, absolutely. So they're factually correct.
Yes.
I'm confident about they're factually correct. So if you convert your investments from US dollars back to Australian dollars, now you have to start considering the fall or changes in exchange rates. And what we've seen more recently as a result of Brexit, you've seen a fall in the euro or the weakening of the European dollar. And you've seen a fall in the pound, and that's a result of Brexit, the ongoing uncertainty around Brexit. So if you look at the previous slide, you've seen the UK has actually done pretty well for the year. Very well, in fact, just over 18%. If you consider the fact that you have to then convert it to bring it back into Australia, we're at negative 5.57. So that's a swing of close to 24%. So it means the pound has lost 24% in its value, which is scary if you're on the wrong side of that investment. Fortunately, we weren't. We haven't been hedging, what they call hedging the portfolio for quite some time now. Locally here in Australia, it's the same theme again. We've seen this huge, phenomenal run-up in equity, the value of equities through time, the price of equities, I should say. Driven by, more recently, a rebound in materials. So that's all the commodities, BHP and the like, Rio Tinto, have really bounced back. And a few of these more higher yielding assets, like I mentioned before, property, utilities, which is infrastructure, it's another word for infrastructure, and telecommunications, which is dominated by Telstra, have fallen quite dramatically recently. And I'll get into the reason why shortly. So that's the theme. So we've had this great run up in the last year. Portfolios, as a result, have done very well. So hopefully you're seeing that in your own accounts. So they have done very well up until more recently, when we've seen some volatility in markets. And that's what I want to touch on now. So what's causing the more recent troubles in markets? Well, my friend Donald Trump, or non-friend now, who thought Donald Trump would actually win the election? One person. Yeah. Yeah.
A friend of his had $100 and made it 10,000.
Oh, phenomenal bet. Yeah. It was one of the most unlikely outcomes we've seen for quite some, just as bad as Brexit.
Yeah.
Fortunately, I like to relay this. Trump is temporary, Brexit is permanent. Just try and remember the distinction between those two as a little aside. So I want to jump into, yes?
No, not be permanent. I have to wait for the Welsh and the Scotch to vote on it as well.
Yeah, correct. There's lots of uncertainty in terms of how it unravels now. It is highly unlikely that they're going to be able to reverse everything out again. Yeah, there's a nationalist wave going through, obviously Europe. Scotland tried to remove themselves, exit out of their relationship with their English friends not so long ago as well. And that is going to continue, and I'll touch on that in a few slides' time. Who thinks a Trump presidency is positive for your investments? 1, 2, 3. Why? Why, Judy? Why do you think it's a positive?
I think he's got a lot of ideas of how to put things in play, you know, like whether or not he can do them. But I like what he's talking about.
Yeah, so Judy's suggesting that he's got a lot of good ideas in terms of stimulating the economy. Yeah, yeah. Anyone else? Fun?
Yeah, I think it's good insofar as stimulating debate, discussion.
Yes.
The world is in a downturn we've touched on before.
Yes.
Around the world politically.
Yes.
And yeah, let's throw the cat amongst the pigeons and maybe come out of this with some change of thoughts on where we're going.
Yeah, great.
At the moment it's just going around in circles in a world for some years.
Yeah, that's right. So Trump, you've got to remember where, sorry, yes?
According to our daughter-in-law, who's American,
Yes.
she was saying that the Obamacare was basically what got Donald Trump in, and they're hoping that as a commercial man against a series of lawyers, that there may be some basic ground stimulus to their economy.
Yeah, no, I agree.
That's directly from the American.
Yeah, no, that's right. So, like, if you think about who Donald Trump is and where he's built his fortune, it's building things, growing a business, stimulating growth. He's looking to do the same thing for the US economy. This is generally what he's trying to do. Forget about all the noise and rhetoric in terms of thinking about breaking it down. What is the likely outcome of a Trump presidency? Well, there's a number. He's suggested he is going to invest heavily into infrastructure spending, roads, rail, buildings, airports, and the like. Sort of the program that the Chinese undertook roughly 7 years ago, and more recently slowed down. That same sort of policy. And what does that do for an economy? Well, it employs people. Typically, you see a rise in wages. You see a lot more spending. You see the corporates who service the infrastructure build do quite well. And overall, you see an expansion of the US economy. So, very simply, we're expecting the US economy to grow faster than it has grown in the last 5 to 10 years. However, with some of his other commentary, we might see an offsetting effect, and be it through trade. So if anyone's heard of the TPP, Trans-Pacific Partnership, he's not a big fan of the Trans-Pacific Partnership. He's highly likely to unravel that, but that's an unknown. There was a lot of he's very open to making outrageous remarks, of course, to get votes. So we don't really know what this means. Is he going to unravel some of these trade partnership agreements? Is he going to call out China for currency manipulation? We don't know. All these things have serious implications for the US economy. Do they become more closed, offsetting the impact of infrastructure spending? We're seeing some really interesting messages around tax reform, corporate tax reform in the US. There's a lot was made around Donald Trump benefiting from this, the tax offset when he made almost $1 billion loss in the late 90s and carrying that forward. He wants to actually reverse that rule out. Interestingly, he benefited from it. He understands that it was probably not the best tax policy, and he's proposing to reverse it out. He's also proposing to reduce corporate tax rates from 35% into the teens, which also has an interesting effect, because you'd think the revenue that government obviously generates falls as a result. But what that does mean is more money hits the pockets of the companies and then the employees. So he's trying to trigger almost a trickle-down effect, if that makes sense. There are a number of other things which could unravel as a result of a Trump presidency. This is all uncertain still. Got to keep this in mind. He's still not even in power. But what we're seeing is two key themes: increase in spending, which is going to trigger an increase in growth rates in the US, but also an increase in likely inflation rates, and a likely or near certain increase in US interest rates. And so that has a couple of effects that we'll see very shortly. Okay. Normally I like to stand in front of a slide like this because no one can read it. It's got tiny little writing. As long as you can make out the 3 different colours, I'm happy. In green is the, can you see, yeah, can this table see that? Is a bit, yeah. In green is Japan. I'll explain the chart, but just keep in mind, Japan is green, Europe is in red, and the US is in blue. Okay. Now, so what the chart shows is down the bottom is dates from 2006 all the way to 2016. On here on my left, your right. And from top to bottom, the percent of central bank assets versus the value of each respective economy. So as a proportion of GDP, a common figure, how much in debt do they have? Okay. Okay, so what we can see in Japan is they've been growing their pile of debt to an astronomical level. Close to 90% of everything that Japan produces as a country per annum is matched by an equivalent amount of debt. And we're talking, if I read out these numbers here, 453 trillion yen in debt. So let that sink in a little bit. There's 12 zeros behind that number. That's how much debt they have on their balance sheet. In Europe, you can see they've somewhat plateaued and more recently increased the amount of debt. Or money printing is probably, and the other turn of phrase that you'll see in newspapers. They're starting to print more money, more recently as well. They're sitting at about 30% of debt to GDP. close to $3.3 trillion. Twice as much as we've got in superannuation assets in this country, in debt. United States, 4.5 trillion. Surprisingly, given the amount of hoo-ha made about US debt relative to Europe and Japan, it's actually not that much. But in sheer scale, it's a phenomenal amount. $4.5 trillion. Who knows where Australia might sit on this little chart here? Anyone? Throw out ideas? Come on, Tony. Pick a number. Low?
Low figure.
Yeah. It wouldn't even register. It's 1.4%. I looked that up last night. Clearly, we haven't printed any money. We had obviously K-Rudd dropping plasma screens from the skies a few years ago with his $1,000 grants. Called helicopter money for a reason, literally just dropping it into your bank account. We should do that every year, just before Christmas. 1.4%. You get an idea of the magnitude of how much money these big economies are printing to stimulate growth. We've done nothing, none of that. And what you'll notice is Japan is still going sideways. They're printing so much money to stimulate economy, get people spending money, putting money in their pockets, but it is doing nothing to stimulate that economy. So they're going to have to try something different. And they actually started just literally buying stocks on the stock exchange. So instead of handing it out to their banks and hoping their banks will pass that on to consumers, they're actually going direct and buying stocks on the Japanese stock exchange. They're also going to try Kevin Rudd's tactic of dropping plasma screens into the local economy. I agree. They haven't done it yet, but it's going to be phenomenal for Samsung. So, but the interesting thing with Japan, I'll make this comment. What we've experienced is that, so although Japan hasn't done very well as a result of this, they have made some fundamental changes in the way that they regulate and stimulate their corporates, so the companies in Japan. So where Japanese corporates have in the past managed their business for the benefit of their employees. So you hear these crazy stories of someone working in a company for 50 odd years from 17 to 75. That is being flipped on its head. So you've seen Shinzo Abe, which is their current Prime Minister, wanting to stimulate growth, increase the return on investment that shareholders get by investing in Japanese companies. And the difference between the two is the polar opposites. One for the employees, one for the shareholder. And so we're moving to this to the benefit of shareholder framework. And we're seeing that come through now in the last couple of years, or the last year in particular, to the point where they're replacing Japanese CEOs with American ones. So it's sort of an underground movement, but we're seeing the return on investment, the amount of money that you make by investing in Japanese companies, rise slowly. Slowly but surely they're rising. And we think this is a great opportunity. And we've held Japanese shares for quite some time to see this trend through. In Europe's in all sorts of problems. We all know that. I won't go into too much detail about Europe. We know Brexit has the potential to unravel the European Union, depending where various referendums go in the next year, in the next 12 months. The Italians have a referendum. The Spanish have a referendum. And there's this, and obviously this nationalistic trend through Scotland. My forebears, lovely Scots.
Question?
Yes?
What is the real situation in Germany and the German banks?
Ooh. Well, you had Deutsche Bank. Everyone familiar with Deutsche Bank? Deutsche Bank is like the German CBA. They're carrying a lot of debt. They're obviously very exposed to what's going on in Europe, but also globally. Deutsche Bank might go broke, but they'll never go out of business. So the German government will always step in to save Deutsche Bank. There's a few other banks in there. I don't want to tie Lehman Brothers to Deutsche Bank, but that wasn't intentional, that hanging in the air. I have a few friends that work at Deutsche Bank.
Is this one of the easier questions?
No, that's a hard one because it's technically very challenging because they also had a huge derivatives book, just like what caught some of these big American banks out. So if they're the wrong side of too many bets, then they're going to have some problems. In reality, they probably won't, to be fair. And the German government will bail them out. Or the ECB will also bail them out because they're far too integrated globally and through Europe. Great question, Bo. I asked him to ask me an easy question before we started.
I gave you the opportunity to give me a list of questions.
But I said easy, right? I said easy. Yeah. Then we've got the US economy I've mentioned. We've seen a bit of a turn in terms of growth expectations. Obviously it's scary having Donald Trump in charge. It's very surreal still for a number of people. Work with a lot of Americans in our office in Australia, obviously, but internationally. And they are scared. I won't say the next word. They're afraid, one, for the perception of the United States and for what Donald Trump is capable of doing. Hopefully we see the good side of Donald Trump, the growth, the economic growth engine that he's proposing to unleash on the world, and not the alternative, as we've seen.
One of the things they got in America, they've got assassination.
Yeah, correct. Well, it's happened before. It's a real possibility. The Secret Service, we know, is having a really hard time with Donald Trump in his ivory tower in the middle of New York. It's going to cost the taxpayers. I saw an estimate.
400 million.
Yes, that's right. It's in the hundreds of millions in terms of protecting Donald Trump and his little 3-level marble palace.
But someone else told me that the security agents will be calling out Donald Duck if anyone threatens him.
Very good. I like that, Mary. Yeah, that's good. That's good. Okay, so it's just that threw me. Thanks, Mary Christine. I appreciate that. You did this to me last year as well, I'm sure. Yeah. Michael, you baited her, I'm sure you did. Yeah. Yeah, that's right. That's $5 at least. Okay, moving. Trying to focus. We've got meal number 4 coming. Oh, I can see it on my table. Okay. Also, 2 new charts here. Again, lots of squiggly lines, lots of colour. The one on the left shows the change in interest rates, so what we see every day, the RBA rate that comes out, for a number of different economies for the last 20 years. And hopefully you can see a trend downwards. That's what I want you to focus on. Can you see that? This one here? It's going from roughly 7.5% down to close to 1%. So a big fall in interest rates. We're not just experiencing this in Australia, this is obviously around the world. Japan is the one in green down here, coming from close to 2.7 to negative 0.3% at the moment, so they're running negative yields.
Yeah, but they haven't dropped as much as some of the others.
Yeah, correct. Percentage-wise, they haven't. Yeah, absolutely. Well, because they've been having some troubles for close to 20 years in Japan. Can anyone understand why you would lend someone money and expect to get less back? It's like me giving Tony $100 and expecting to get $95 back 2 weeks later.
What are they going to get in the bank?
Yeah, that's a good bet. Yeah, that's right. Why would you do that?
if they're your adult children.
Exactly.
Adult children, that's right.
Or your money laundering.
Money laundering, that's right.
Or to your bookmaker.
Pardon?
To the bookmaker.
Yeah, that's right.
He doesn't give you enough of that.
No, well, they take a huge spread, don't they?
Or you
Hate bookmakers.
possibly have a tax problem that you'd like to
Maybe.
offset.
Maybe, yeah. Anyone else?
Or you're in business for yourself, and that's what
yeah, that's right. Or I make the difference. Yeah. What we're seeing is that two things that would drive this scenario. One, if you expect inflation to not go up but go down, deflation. So the value of a bottle of wine goes from $20 to $15 in 2 years' time. So you're actually losing money by holding on to it. Makes sense? And so by giving Tony $100 and expecting 95 back, maybe my expectation is that that $100 is only going to be worth $85. So which means relatively I'm $10 up. Does that make sense? Great. The other one is if you expect interest rates to keep falling. Japan continues to have to stimulate their investors to invest by decreasing the amount of the return expectations of existing bondholders. That can be very confusing. But by falling, here's a good question. Does anyone understand the relationship between bond prices and interest rates that you get from bonds? Michael and Matt, put your hands down. Anyone who wants to have a go? Who has grandchildren or children in this room? Yeah. Anyone visit a playground recently? Yes? Okay, very good. Okay. It's like a seesaw. Literally, it's like a seesaw. When interest rates go up, bond prices go down, and vice versa. As interest rates go down, bond prices go up. So if we look at these charts with bond prices, interest rates falling, if interest rates are falling, bond prices are going up, which has been really, really, really good if you've been holding bonds. The problem that we have right now, which you can start to see on the right-hand side, you don't need to look too closely, is we're seeing that change. We've seen it fall for the last 5 to 7 years. We're actually seeing the start of a reversal of that. So you get the opposite effect. So as interest rates start to rise, bond prices fall. And the concern is if we see interest rates or the interest we expect to earn off bonds rise too much, we see big falls in the value of your bonds in your bond portfolio, in your portfolios. And it's made even more extreme given interest rates are so low. I won't go into the maths of it, but the lower bond prices are, so the lower the interest rates are, any small change in that interest rate has a larger, a magnified impact on the price of that bond. I'll leave Michael to explain that one at your next review meeting. Yeah, my pleasure. This is why no one is interested in bonds. It can get very confusing. It's very maths heavy. But it's important. The important thing to remember is we're seeing a change in the trend. A change from falling interest rates to rising. And if we're seeing rising interest rates, we're seeing falling bond prices, which is not good for portfolios holding lots of bonds. Luckily, we don't. The other major theme, which also impacts bond prices but also share prices, is inflation. One of the key drivers or inputs of inflation we've seen more recently is energy within the CPI plus number, so the Consumer Price Index. It's basically a pool of household goods that we buy every week, and they track the prices of that pool or that basket of goods. And when things go up in that pool, it signifies a change or an increase in inflation. One of the biggest components of that is energy. The inputs that are used to transport product from Coles warehouse in Brisbane to Coles in Mooloolaba. They use diesel or oil. So when the price of oil falls, that's a good thing because Coles makes more money and they're able to keep that for themselves and pass that on to, obviously, hopefully investors, but not to consumers, of course. The same is true when you reverse it out. When inflation, when the price of oil, which we've seen more recently from January this year, increased by about 100% in 9 months. 100% from bottom to top. And that impacts inflation. And inflation impacts the value of also of bonds. It impacts the amount of money that Coles can make as the cost of inputs rise. The cost, or hopefully the cost of the end product doesn't rise. Hopefully they just make less money, which is what we've seen. But the key theme is if inflation rises too quickly, Coles and corporates can't keep up with that growth and they start to lose money. And the value of the shares that are attached to that company start to fall. So it's important for us to monitor inflation because we want it to grow, but we don't want it to get out of hand. And so we're hoping oil stabilises because we have a number of investments in oil-based companies, but not too much to affect the rest of the portfolio, the rest of the companies in our portfolio. Does that make sense? So we've got a key focus on interest rates and what happens there in the next 12 months, and a focus on inflation. We can see that in this chart here. On the right-hand side is Australia, and in it's kind of a reddy orange colour. With I started to get into a bit of design before we got here. That is the average inflation rate in Australia for the last 20 years, 2.8%. This year, the 12 months to September, 1.3%, so almost half. We're actually looking at probably 1% for the year to December end. And coming from the IMF, they're suggesting we're going to see a jump, almost a doubling of inflation next year in Australia to 2.1%. Now this is common across all major markets. We're seeing this jump in inflation, and it's almost all triggered by this 100% lift in oil price. So we have to be very careful about where we're putting our money to make sure it is protected from the risks of inflation getting out of hand. We've been waiting for this moment for quite some time. We thought all this money printing in Japan, in the United States, in Europe would have this effect by pushing up prices. It didn't, at least not in the goods that we see on our plates today. We certainly saw inflation in asset prices, in property. We saw it in residential property and commercial property, in infrastructure assets. We just have to be very careful about not letting this get out of hand. Not something that we can control. We can control what we invest in that may be impacted by this. So we've got interest rates and inflation, and then we've got a lot of uncertainty. And there's roughly 8, 9, 10 points on here, events that we're likely to move through over the next 12 months. We're seeing a Trump presidency. Naturally, that's the most immediate one, and how that unfolds. We have Spanish elections, focusing on fiscal reform, so changing how they manage their economy. We've got obviously ongoing Brexit concerns and how they unravel that relationship. And I implore you to remember, everything you see in the newspaper is typically noise. So it's not actually, what you see in the paper is not driving future asset prices. It is already in the price that you see that day. I encourage you to look at it at a grain of salt. It's sure it's entertainment, but it's really not what drives the performance in your portfolios. Picking what happens in each of these scenarios is like a 10-leg multi-bet. Who bets? Okay, Mary Christine Betts. You would have got number 1 wrong, Trump presidency wrong. There goes your multi from day dot. The likelihood of actually picking all of these right as an investment manager or as an investment house is near on impossible, because there is so much uncertainty around each of what happens for each of these events here today. So I just want to break there. Is that
Enjoy it.
good time? Yeah, that's good. So everyone's eaten bar myself. I'm looking at this plate. Was it good? Excellent. Yeah, I can't wait. So we wanted to split it up in 2. This is naturally looking about what's happened to date. What are some of the concerns that we've got as managers? And I just want to reiterate. Changing interest rates from a falling interest rate environment to an increasing, the likelihood of an increasing interest rate environment. And we're seeing, I saw it actually today, we're expecting Australian interest rates to rise maybe at the back end of next year. And there's also 100% certainty priced in for a US interest rate rise next month. Michael.
I read the paper this morning and banks are putting interest rates up on Monday.
Right. So, yeah. So what happens is, when there's an expectation in the US that rates rise in December, that's already priced in to market. So financial markets have already said, okay, the price is going to be much higher. Australian banks, 30% of their funding comes from the United States. So they have to borrow in the US. If that cost of borrowing in the US goes up, it means that has been passed on to Australian consumers.
That's exactly what we said today in the paper.
Right, yeah, that's good, mate. Yes. Not that I read that article, but that's good. Which is exactly right. So if we see US interest rates continue to rise, which is very possible under a Trump presidency if they continue to grow, we'll see interest rates in Australia rise at the same time as well. Okay, so you've got the risk there, obviously home loans and the money, the debt that we carry as individuals. We see it in the cost of debt that corporates carry. So if they have to pay away more in interest rates, they make less profit, and obviously the price of those companies comes down. As interest rates rise, also bond prices fall. So there's a lot of bad things that can happen when interest rates start rising. Likewise, inflation. If inflation figures really start popping, like interest rates, then we also have the same problem. So there's a lot of risks out there. I just want to paint somewhat of not a negative picture, but a cautious one. It's time to be very, very prudent about how we invest our money right now, because this is unknown territory for everyone, including ourselves. So we'll just have a quick break. I'll sit down, have some course number 4. I think it's number 4. And then we'll see for the other side of the coin, where are we finding opportunities as a result of what we've seen so far. Okay. Thank you. So I painted a fairly negative picture.
Thank you.
Thank you. All right. Is everyone very concerned? Okay, right where we need you. Now what I'm going to look to do is almost lift the lid on a lot of the intellectual property that sits within our business. A lot of the hard work sort of uncovers opportunities, and it's these opportunities which flow into your portfolios. Okay? The challenge that we've experienced has been the limited number of opportunities that we've found to fill a portfolio in a prudent way. And so introducing this very colourful chart, you can see a series of greens, reds and blues. Now this is a chart which is somewhat at the core of what we do as a business. The inputs the work that goes into producing this chart is quite phenomenal. We mentioned that there's 27 offices around the world. There's something like 350 individuals focused on this work every single day. To simplify it like this doesn't give it that much justice. This is one of the key metrics that we look at in terms of uncovering or deciding what we want to invest in. And so in green, here we go. Green represents where we are expecting to receive a positive return from each respective asset class. Red, where we expect a negative return for those particular asset classes each year for the next 10 years. And so down the bottom, what you may not be able to see is the list of assets. And there's roughly 320 that we track every single month. To give you an example, on the far left-hand side here, we've got Korean equities, so South Korean equities, followed by European energy, so BPs and Shells of the world, Taiwanese equities, European utilities, so European infrastructure, all the way down to the other end, something called global aggregate bonds. Great name. Global aggregate bonds are referencing those bonds that I suggested were at greatest risk of falling in price. And so when we look at each of the different assets in the universe that we can invest in, the first stop is a chart that looks like this. And what you can see on the far left-hand side, Korean equities, we expect to generate close to 7% per annum for the next 7 years. So roughly 70%. This doesn't include inflation. So if you add another 2% to that, so closer to 9% per annum for the next 10 years, that's what we expect to receive by investing in Korean equities. If we choose to invest in Australian equities, so the ASX 200, we expect to generate no more than 1.5% per annum for the next 10 years. That's just not much. And so what does that suggest? If you don't have any idea of what that might suggest, from a valuation point of view, obviously that's not attractive. So it suggests that prices are very high relative to their value. So price is what you pay, value is what you get. We expect the price either needs to fall to improve the attractiveness or the expected return, or the value of that company has to rise significantly, so greater revenues, greater profits, etc. But if nothing else changes, we expect to see a 1.5% return out of the ASX 200 each year for the next 10 years. US equities look a little bit worse at 1.2% per annum. European equities, 3.5%. So these aren't very attractive numbers. You've got the bond universe. This far right-hand corner here is populated by the bonds that I was talking about. We expect negative return by investing in the bond indexes that we've got on the right-hand side here. On the far left-hand side, as you heard me reference different countries, you probably heard some foreign names. Taiwan, South Korea, you've got China in there, emerging markets as a group, obviously Japan as well. These are the most attractive investments from our perspective. And what you've seen in blue, when you see the blue bar below that neutral line there, it means that the expected return has fallen by this amount. So this one here, the third one in, is Taiwanese equities. We've seen expected return from over the last 6 months fall from close to 10% to 6%. And that references a fall in price. Oh, sorry, opposite. An increase in price. So it means our expected returns fall. Does that make sense? Yeah, okay. And so naturally, what would you expect us to do when we're building your portfolios? Pardon?
When it's low.
Yes? What assets would we be buying? It's a simple question.
The green one.
Right, the ones on the left. Yeah, very good. Correct, yeah, that's right. We hope they are. That is, and this is essentially, this is what we're buying. This is what we're investing in at the moment. We are not investing in bonds, although we do pick little slices of the bond market that are attractive. Keeping in mind that each one of these is the index, so it's like buying the ASX 200. There's obviously 200 companies in the ASX 200. We can buy, you might see 15 to 20 in your own portfolios, or 10 to 20 in your own portfolios. So we can actually pick specific companies in the ASX 200. And so our expected returns of those particular companies is higher than that 1.5%. Likewise with the US equities that we buy as well. But that is the lens that we look through the world in. Now, if we break down the bond universe, now I mentioned that we'd still invest in specific bonds. Bonds are a scary place right now for specific components of the market. In red, where we expect a negative return, again in green, a positive return. On the right-hand side, I'm gonna call them out. On the far right, UK bonds, UK government bonds, European bonds, Japanese bonds, Australian bonds, US bonds, Chinese, Hungary, Thailand. On the right-hand side, Brazil, Peru, South Africa, Mexico, Colombia, Russia, Turkey, Indonesia. You get an idea of who or what countries populate different ends of this chart. You'd say these on the right-hand side here, Japan, Australia, the EU, UK are the developed markets. The markets that we feel safest investing in. We invest in bonds because they're supposedly safe from capital losses. We're not, typically as investors, we're not very comfortable investing in Peru or Brazil or South Africa, Mexico, Colombia or Russia. But those are the countries which have the greatest potential upside by investing in their bonds. They're mispriced. It's another great way to describe it. So they're overvalued down here, undervalued up here. Carl?
So they are a higher risk then?
Yes, absolutely. So when I suggest this is one view that we look at, so there's a lot more that goes into this. This is the expected returns. I'm actually going to, the next chart gives you the other dimension, so the risk. So we've got to be thinking about how much risk are we taking by investing in Brazil or Peru or South Africa, and then adjust the portfolios accordingly.
This is why you have a good company behind you that does great research.
Yeah, that's right.
It's not high risk, but it's certainly a little bit of risk than standard.
Yeah, it's sort of living on the edge, you know. You don't want to be doing that. That's a joke. That's a throwaway joke. Do not live on the edge in the investment world. Bad things can happen. But yes, you need to be compensated for that risk. You need to be more than compensated for that risk. Yeah, correct. So there's a neutral point, which is sort of the long-term average, the amount of risk, so amount of return given a level of risk that you expect. That's neutral. We're hoping to get a greater return for the least amount of risk possible. You know, it's a fairly simple way of thinking about it, far harder to do in practice. But the general themes here is we're seeing a bias towards emerging markets, or markets that we're not typically familiar with, because they have not grown. Or we saw the first few slides that I presented, these huge performance numbers, 20, 15%. That means they're bringing forward future returns into the present day. It means we can't get those same returns into the future. So we're going to have to look somewhere else. And we're looking at emerging markets. And in fact, we have purchased bonds in emerging markets, and we are underweighting exposure to the EU, UK, US bonds for that reason. Does that make sense? Okay, great. Now this...
Can I interrupt?
Yes, you may.
What you're looking at in those emerging markets is stable sort of companies and things that are looking like being long-term. Banks, maybe, mines.
Yeah, so it's in nature. Oh, well, I'll go back because actually Matt mentioned something as we were sitting at the table there. So thinking about what we're actually buying. So when you think about South Korea as an opportunity to invest, we're getting close to 10% return each year for the next 10 years. What do you think when you hear South Korea? What would we be investing in? You're well informed, so I'll put it that way. All right.
Shipbuilding. I'm not giving the answers.
Industrials, yeah, correct. Nuclear weapons. Well, yeah, that's right. Yeah, hopefully. Well, if Donald Trump's plan goes right, he's hoping to arm all his alliances with nuclear weapons, which is a scary thought. Yeah, that's right. Thank you, Mary. So when we think about South Korea, what are we actually buying? We're buying the phones that you have in your pocket. And in fact, a lot of componentry that sits within your iPhone comes from Taiwan and South Korea. The television screen, it's a Braun. Okay, I was hoping it was a Samsung. It is not a Samsung. Obviously, Samsung makes televisions. Likewise, LG make televisions. These are all South Korean companies. Kia, Hyundai. They're all South Korean businesses listed on the South Korean Stock Exchange, and we invest in that stock exchange. Interesting side fact, Samsung as the conglomerate makes up roughly 60% of that stock exchange. So when you're buying the South Korean index, you're buying Samsung as a business. It's a great business. It's a very good business. And when you're looking at those businesses, yes, Mary?
Talking about emerging countries, I'm looking at India.
Yeah, so that's a really good question. We actually we do indirectly own parts of India through the emerging market ETF. India's a really hard one to actually value. It's changing very quickly. So we've struggled as a business to invest in it. We have a team in India, and we're hoping that we can get closer to that market because it presents a lot of future opportunity if we can get it right.
Regan, you
Michael.
mentioned ETF.
Yes. Yeah, sure. An ETF, you'll see in your portfolio lists if you log in or Michael presents a list, you'll see iShares South Korean ETF. Has anyone seen something similar to that? Well, the ETF component at the end of it, it's an acronym for Exchange Traded Fund. So all it is a managed fund listed on the ASX. So it means you can buy and sell that fund with daily liquidity, which you can't do for off-market managed funds. It takes somewhere between 3 and 8 days, sometimes 2 weeks if they're a terrible managed fund, but usually 2 to 3 days for a managed fund. ETFs, every hour that the ASX is open, you can trade an ETF. So it's just a managed fund listed on the stock exchange. Correct. So when we look at the different companies that make up those ETFs, we're actually looking at the companies underneath that sit within that index. So we're looking at Samsung and we're valuing Samsung as a business. And we're looking at how much money does Samsung make? Revenue, profit, do we think it's going to increase or improve? Are they going to get bigger? Is it going to be a good investment? And we do that for the likes of Hyundai, etc. So we have teams that sit in Asia, in Tokyo and Seoul, that actually look at these things for us to make sure our thesis is right, which is where the risk component comes in. It may look attractive on the surface, but we want to know why and making sure that our thesis is correct. So we do that for every investment that we make. Okay. Now this is adds the second dimension. It's effectively the same information that you saw on the first chart with the risk dimension added to it. So it becomes two-dimensional. So from bottom to top, the last, a zero expected return is this long line here down at the bottom. So anything that sits at that level, this way, zero expected return. So cash in bank, we expect to make nothing out of that when you remove the effect of inflation. Everything above that line is positive. So right at the top here, we're talking about Korea, it's right at the top up here, as you'd expect. The other dimension is the right to left. And right to left represents the lowest risk to the greatest risk. And so what we're measuring is the amount of money that someone has lost by investing in that particular market at that particular valuation point. And you can use, everyone heard of PE multiple? Brokers use it a lot. Price divided by earnings. It's a proxy to figure out how expensive something is. And we try and map using it. It's a little bit more complex than I'm making it out to be. But we calculate how much that asset has fallen in history from that point to its lowest. That is the maximum amount we expect you could ever lose from that asset class. Not to say that it can't bounce back, but that's how much we would lose if we bought in at the top and sold at the bottom. From right to left. Naturally, cash, way over to the right here, you cannot lose cash. All the way down here on the left is A-REITs. So we spoke about Australian commercial property. We believe they're generating a small return. They've done exceptionally well, but we expect future returns to be a lot lower than they have been in the past. And the risk that you're taking to get that return is extremely high. So naturally, and that's because it's in red, we don't want to be there. So you'll have seen in your portfolios from this time last year in October, we started selling out of A-REITs. Or commercial property. Again in May, we sold some more as it went higher and higher and higher. More recently in October, just last month, we sold even more again to the lowest level we've ever been in those portfolios because we feel like we're not being compensated for the amount of risk that we're taking or having to take to generate that return. Conversely, ideally we want to be right up here in the top right-hand quadrant. The greatest amount of expected return with the least amount of risk. And so as an example, I just wanted to point out a few of these which I'd never normally show, is European equities on a whole sits here, just above this line. So a positive return, but you're taking a reasonable amount of risk to generate that return. If you broke down that market into different sectors, you'll find European energy, so your BPs and Shells and the like. You'll find European utilities, so your infrastructure assets, so airports, railway lines. Yep, fire away.
As that line goes up,
yes.
Are you calculating that as a bigger risk because it has increased?
So if the line goes up, it means we're expecting better returns. Better. Yeah, if it goes up. Yeah. So
what about the risk value?
Yeah. So it's if things are getting more expensive or riskier, you'll see these dots move to the left. Yeah. So you don't want to be investing down here.
Below that.
Yeah. You want to be investing up here. And so there's a few hundred other little dots that you could put on this screen, and you'll find a number of them that sit up here, but there aren't that many. And what we've seen, that the trend has been, this line here represents the what they call the fit of the curve. It gives you an approximation of how much risk you're needing to take through the entire global economy to generate a certain amount of return. We're seeing that fall, so we're seeing the expected returns fall significantly through time, and so we're getting more concerned. Although we're getting almost 0% return in cash, you'll notice there's a reasonable amount of cash in your portfolios. It's because there isn't much up here to be investing in. So we'd prefer to hold, sit in cash in wait for better opportunities.
Yeah.
It's
so
better.
You're positioning yourself to buy.
Correct. So we're positioning ourselves. Yes.
What are the risk factors that mean that things like Korean equities and Taiwanese equities that look good on the slide?
Yes.
Why are they over there? What are the risk factors? Is it political instability? Is it?
It's more around valuation risk. So the risk that we get. So just to point out very quickly, just because something's in the middle doesn't mean it's very risky. Yeah, bad. So for equities, you have to take risk. You have to take risk. You're always going to be somewhere in here. Pardon?
And shares.
Shares. Sorry, equity shares. Shares. Yes. No, that's right. 5. What am I up to now? $20. 20. That's right. So we'll always be somewhere in the middle. What it gives you an opportunity to look at is the relative opportunities that you have. Would you, at this axis, this amount of risk over here, would you prefer to hold Australian equities or what's something closer? UK equities. You'd go for the UK equities, right? Compared US versus Taiwan, you'd go for Taiwan over the United States. So what it is, it's not so much it's really risky because there's always risk attached to it. You just want to find the best opportunity given the same amount of risk.
This is going back quite a bit.
Yeah.
We had the green Taiwan, South Korea, and so forth, and that. Would you ever? They're going quite well.
Yes.
Going by chart, but it's short term because there's a bit of high risk there.
Yes.
Would you ever think of going into that? It's speculative, isn't it?
Why going in?
Would they ever go in for a short term type of thing?
Well, it's a really good question. So, yes, but it's not for the sake of short-term investment, if that makes sense. So, when I say Korea is likely to generate 7% per annum, we could see that happen in 12 months. So we could get 7 by 10 years, 70%. We could see that jump by 70% in the first year alone. It could happen in 2 chunks, in 2 to 3 years from now and then 7 to 8 years from now. We don't know when we're going to see these returns. But if it does happen suddenly, like it actually did in Japan in 2011, just after the tsunami, it jumped about 80% in the space of 4 months. So in that case, yes, it's a short-term investment because we've realised all the returns we were hoping to realise, to make. Yep. So it's not so much an input, it's just an output of what we do. It's a very good question.
It can go wrong though.
It can always go down, absolutely. It can always go down. I mean, we don't have a crystal ball. And anyone that does suggest they have a crystal ball is lying. You do not have a crystal ball in this industry. You have it, no, that's right. Yeah, bowling ball that no one can see into. So I want to take what we just saw about and some of the comments around what's attractive and what's not attractive, both in equities and bonds and in different regions, and have a look at where we're positioned. And this is, in some of the quarterly reports that Michael has access to, and you may see from time to time, has sort of positioning around where we're at in big asset classes. On the left-hand side here, you'll see Australian shares. Typically, in a balanced portfolio, which is what this is, you'd expect to find somewhere in the vicinity of 25 to 35% in Australian shares invested. Now, if you remember, our view on Australian shares wasn't all that positive. So you'd expect us or hope that we're underweighting Australian equities, which is in fact what we're doing. We're holding close to 12% in a balanced portfolio compared to an average portfolio or fund close to 25 to 30%. Similarly, in cash, we're talking about there isn't all that many opportunities in the market. It's becoming more and more challenging to find those opportunities. So what do? Do we put money at risk, or do we put it in our back pocket waiting for a good opportunity? And that is what we've been doing. We're holding close to 22% in cash in the balanced portfolio. That would typically, depending on your manager, sit somewhere closer to 3 to 5%. So it's a lot more. You're holding a lot more cash. And when you look at global equities, so we've pulled all of those global equities together. So the US, Taiwan, Korea, European, Japan into one big bucket. These are all these down here added into one. We're holding close to 30%, which is about the equivalent to your peer, to the peers in the market. The difference is the makeup of that. So where we don't have, we've got very, very little, or at least an underweight amount of US equities, because we don't feel like we're getting compensated for that risk. We're far more comfortable holding Japanese equities, European equities, and emerging market equities, like I pointed out.
The question there, like we're talking about in Japanese equities.
Yes.
Japanese shares.
Yes, shares.
But you mentioned before that their debt level is super high.
Yeah.
So that might sound really strange to people in the room. Why you go?
Yeah. Good, really good. In fact, John and I had a conversation about that over the fish. Yeah, I was struggling to eat my fish because he kept asking me questions. That's okay. It's a really good question. So you've got to distinguish between government debt, which is the huge number that I spoke to, the 480 odd trillion yen, and the corporates that I spoke about. And when I spoke about the corporates, the changes in focus from from employees to shareholders. So we're investing in the corporates, not the bonds. That makes sense. So you've got to really start dividing your opportunities out and filtering those different opportunities. And even within Japan, you can carve out the opportunities within that market. Fortunately, at the moment, the index is an appropriate way of accessing Japan. That can change very quickly, and we'll look to access that in a different way if that changes. Does that answer the question, Michael? Very good. That didn't come out as well as I was expecting. What I just really wanted to demonstrate was the change in allocations over time. And so when we're making decisions, although you can't really see it, you'll see this big chunk of yellow at the top here. Now it represents international shares. You can see over the last 5 years, that chunk of yellow has changed. It's been roughly 20% to about 10 to 15. And more recently, it's increased. It's actually increased again. Australian shares have been very lightly held or underweight in our portfolios for quite some time, and for good reason. That has fallen in last month. We've actually sold out of Australian equities more recently in October. And we've increased our international shares exposure. And you will have seen an interesting holding in that, hopefully in that international shares bucket. We actually bought the British pound. We didn't buy British companies, we bought the British pound. Why do we do that? Yes, excellent. Michael's been teaching you very well. Because it's fallen significantly, no one wants to buy it, and we feel like it's undervalued. And what do we do when things are undervalued? We buy it, because we've got lots of cash to do that. And so we'll continue to do that. We'll continue to move the portfolios around to take advantage of these opportunities, and not put your capital, your client, your life savings at risk by doing so. So I just wanted to summarise very quickly everything that we said, that I've mentioned. So up here, and I think Michael's going to summarise some of this as a takeaway.
Wasn't my aim.
Okay, maybe not. Matt's going to save Michael. Okay, very good. I'm very happy if you're going to take this slide and use it, Michael. Very generous. So what we've seen, key asset classes are very expensive across the board. We've seen expected returns falling over a long period of time. We expect a lot more volatility. With all of those events that I outlined over the next 12 months, we expect a lot more of this whipsaw effect in share markets and bond markets. We don't know what's going to unfold with Trump's presidency, nor with what happens with Brexit. So really, as I mentioned when we started the second half of the session, it's really time to be prudent, to be thinking about how do we fine-tune the portfolio to take advantage of those opportunities when they arise, but don't overextend ourselves. And we need to move away from high-yielding assets. So the property, I've mentioned, we've reduced that exposure. We've reduced exposure to infrastructure assets. We've reduced exposure to shares that have high yields, like your Telstras of the world. And we're shifting them back into some of the more traditional, sort of the equities, into the British pound, which is a more traditional investment, and the like. I'm going to finish there. He's kicking me off stage. I just want to say thank you very much, Michael, obviously, for inviting me back. I really enjoy, obviously, spending time with our mutual clients. I think it's very beneficial. And please, if there's any feedback that you'd like to give back directly to me, please do so, and I'll keep, obviously, Michael very well informed. So thank you very much for your time. I very much appreciate it.